Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com. Stock market seems to have shrugged off the sequester deadline without a problem and even closed out the first trading day of March on a high note. So what's next? We're going to see if our panelists can clue us in on what is next for the stock market. Our research director, Shiraz Mian, equity strategist, Tracy Reineck, and ETF strategist, Eric Dutram, here with me in this edition of the Roundtable. So, January, great rally.
That's right.
February, market closed out on a high note. Does this kind of seal the deal that market's going to be up for the rest of the year, Shiraz?
Oh, no, absolutely not. We have actually
shook up there.
we actually have been starting on a positive note in recent years. That's the new style for the market. January, February, and it's a little bit later that the worries start creep in. So that's how we started 2012, 11, 10. I don't really see why this year should be any different. They used to talk about the sell in May and go away thing.
Are you suggesting up to March?
Are you suggesting that we should sell in March and go away?
Yeah, I'm just asking the question. I'm not suggesting anything.
I think there are some serious questions about the outlook for the second half.
Okay.
And how optimistic the market's view about the economy, about earnings, and all those weighty questions is. And as we get closer to that stage, it'll become clearer that the earnings growth and the economic growth that everybody's banking on will not be there.
Okay. Eric, you seem to agree with that theory.
Definitely. If you look back to 2011, we saw a very similar trend. The first couple months of the year were pretty good, and then we had a lot of issues going into the third quarter with the whole debt downgrade of the U.S. and other like political issues. And I think we could see a repeat of that this year. Maybe not U.S. political issues, more Europe. Italy is still kind of in flux. We don't really know how that's going to play out, and who knows what's going to happen in some of these other European markets. So I'm kind of staying with Shiraz here. I think it's okay for now, but could be a little rough once we approach the midpoint of the year.
Okay, so Tracy, you say even with the market at new highs, or very near all-time highs here, it's all about earnings and valuation yet. It's not about how high the market is. But what about the thesis that some people have that with all this new wave of fresh money coming into the market, that is like more powerful, and so Italy concerns and sequester really, because of this new wave of money, won't derail this rally?
Well, yeah, I mean, I somewhat disagree with these guys, not about what they said that it could get rocky in the second half of the year, but that I think the market is still just going to blow by that, because we did it last year, even though it got rocky and no one knew what was going to happen in the second half. And we closed out the S&P, up like 17% for the year.
Yeah.
So I foresee that happening again, because people are banking on, China really recovering in the second half. And then, the rest of the global economy picking up the same thing we did last year. But I do think that this rally will continue on. There is some money.
This wave of money powerful?
There is some coming in. I mean, you can see the speculation starting to pick up, and like in all asset classes, and some of that is because the central banks are keeping this basically free money policy going worldwide. So the money is going into all of these assets somewhere. But everybody's been talking about this great rotation out of bonds and into stocks. I'm still waiting for that to happen, because they're still all piling into the bond market like they were the last couple of years, and it's supposed to be coming out of that and into stocks. And yes, we've seen a little bit more coming into stocks, but not what it should be if you're really seeing a rotation.
So one of the things, sorry to cut you off.
No, that's all right.
One of the things that gave us the strong gains in the back half of 2012 and coming into this year was the reduction in the worries about Europe, the improving outlook for China, and then our completion of the elections and the fiscal cliff issues and all of the problems. All of that is now in the background for us. And the gains in terms of the multiple expansion that we saw in the market is now behind us. In fact, on the Fed front, now we have this increasing noise from within the FOMC of taking another look at that stuff. So the easing effect from the continued purchases of $85 billion a month in bonds versus the offset of that from the noise and the market positioning itself for the eventual exit of that easy policy, that basically offset each other.
Okay, well, let me ask you this. We've got the transports, and we talk about the transportation average, being a leading market indicator frequently here on the roundtable. You've got, so far for the year, transports leading the gains, up 13% compared to just 7% of an increase for the Dow Jones Industrial Average. Is this a trend here to drive the market higher?
Well, like I mentioned earlier, the outlook for the economy is very optimistic in the back half of the year. So we have these softish numbers like the Q4 GDP number, barely positive, but everybody's discounting that, looking ahead to far greener pastures on the horizon, both here, internationally, and that's what you are seeing in the momentum for all of these economically sensitive stocks as well.
And so you say that transports are just underscoring that outlook.
Absolutely, and I think that's way too much optimism.
What do you guys say?
I think there's been a lot of solid data as of late, and this is kind of helping to power the transports higher. We're seeing a lot of positive manufacturing data. Some of the emerging markets are starting to come back. So I think this is kind of feeding into stronger transports heading into the March and April.
Positive trend, bottom line?
Well, I get a little nervous. I'm not too worried about, the trucking and the railroads doing a little bit better, but when you start to see the airline stocks doing what they've been doing, that area has been kind of dead money for many years, and they're all been soaring.
That's right.
I get a little nervous when I see like that part of the transport's doing better.
And you've said that before as well.
Yeah.
That you had some skepticism about the airlines.
Well, yeah, and they've come real far. I don't know how much more there's to be there, but you're still seeing it in the railroads. They continue to hit new highs, and everybody's assuming manufacturing and that the economy is going to be picking up enough to support the railroad.
Okay.
But if you go back to airlines real quick, I mean, oil prices have been relatively under control, and the consumer is still surging higher despite the higher taxes. So I think that's kind of playing into the stronger outlook for the airlines.
Market wasn't also shaken by the latest GDP numbers. Of course, Eric says GDP reports are worthless. Anyway.
Well, I mean, we're talking about stuff that happened in October and November, and
Right.
we're now in March. I take the position of who cares about that?
Right.
Let's look to some more recent data. Either on the employment front, consumer PMI, the Chicago PMI that just
Right.
came out last week was very positive.
Yeah.
I say let's look to the more recent. We always focus on earnings estimate revisions here. But for some reason, for GDP, we like to look backwards. It doesn't really make a whole lot of sense to me.
Hold that employment thought for just a moment. What about a GDP report? Worthless?
But yeah, I mean, the second revision, you're not talking about history books. I'll agree with him. The first time when it came and it was negative, there was a big surprise. Everybody was shocked that we got into the negative territory. But even then, the market looked past it. It was a defense and government spending. And another takeaway from that report could be that it gives us a preview of how the GDP numbers will look should the sequester cuts do not get reversed. So if you have this 0.3% to 0.5% GDP effect of the sequester, and you are in a 2% economy, then 1.5% is the going rate for headline GDP.
So the big data this week quickly is Friday's employment numbers that come out, as we sit
That's
here
right.
on a Monday and talk about that.
That's right.
Anybody seeing any possible surprises there? Or?
It could be distorted by the East Coast snowstorms. The survey period was a week after the storm. Was it a week after or a week before? But there could be distortions there, so we may not get the underlying trends. My sense is that if there are no distortions and what we saw from the jobless claims data lately, then we should have a positive number relative to what we saw last month.
And Eric says it looks backwards, and so he's focused on ahead.
What I'm saying is it's just a couple weeks, whereas the GDP is much further back.
I understand.
And things have really changed a lot, since October, November.
I just like to give you a hard time because it's so easy.
I know that.
All right, that's the latest from here on what lies ahead or may lie ahead. We'll have to wait and see how it all plays out. What lies ahead immediately for us and you is the top stock picks. So just click to the next segment.